Hi, everyone. Oh, hi. A lot of friends. Welcome to Stable Summit. I'm Anna Stone. I'm super pumped for a great panel with wonderful guests. By way of introduction, I'm here from Cork Protocol. Cork is a new solution for tokenizing different on-chain risks, whether that be liquidity risks, slashing risks, depeg risks. We're creating composable infrastructure to apply tokenized risk to a range of different use cases. And so, of course, we're thinking about yield products and yield approaches, which brings me to today's panel, which is DeFi yield real? Almost an existential question. I was, in preparation for the panel, walking around Cannes this morning and started to think about when did I first become familiar with even the concept of DeFi yield. And I hearkened back to around 5 summers ago. The year was 2020, and it was DeFi summer. And like many of you guys in this room, probably you saw that every single week, and then it seemed like every single hour, there was some new DeFi project that was coming out with a super high yield product. Whereas in the traditional financial industry, we were looking at yield products that were yielding around 1 to 5%. In DeFi, we were presented with new products that were thousands of percent. And funnily enough, many of them were farm themed. You know what they say, like if something seems too good to be true, then it probably is. And that's exactly what happened from many of those early projects and products. We saw by 2022, basically all new money drained out of the space. Many of those early yield projects were funded by essentially token inflation, right? Printing money. And bringing me to one of my favorite crypto terms, Ponzi-onomics, right? Where the high yield product was actually the basis of new money flowing into the protocol. And the second that new money stopped to flow in, token prices collapsed, yields collapsed, and many of the early investors were left holding the bag. I think this creates a lot of the suspicion and the loss of confidence around DeFi yield, bringing us to today's conversation, right? So now in 2025, I think we're in a little bit of a different situation. Many new protocols, new and old, I guess, are experimenting with the concept of real yield, right? That's tied to underlying productive assets. And so that's what we're here to talk about today. And so I will let each one of my esteemed guests introduce themselves, their projects, and who their customers are. Let's start with you, Michael.
Hi, everyone. Yeah, thanks very much for having us. So yeah, I'm Michael. I'm the CEO and co-founder of Euler Labs. We built Euler, which is a lending and borrowing platform on nine different networks at the moment, and more to come very soon. Yeah, fundamentally, we let people deposit a variety of different assets, crypto assets mainly, I would say, as collateral, and take out loans of other types of assets, which tend to be stable coins, I would say. Increasingly, we are seeing adoption of real-world assets on the protocol, so collateralization of tokenized funds or tokenized stocks, even, and using those to take out loans. And yeah, fundamentally, I suppose who are users? We have a few different classes of users, I would say. There are fundamentally lenders who want to earn yield. They come in different flavors. Some of them are fairly passive, just individuals depositing. Other ones are aggregators. We've got Superform here. Yeah, and then on the borrowing side, we have people that are typically looking to take on risk and speculate on the market or hedge out risk. On the other side, they tend to be more professional types, I would say. Yeah, and very, very recently, we also announced this new product on top of Euler called Euler Swap, which allows an interesting way for swapping and lending and borrowing all to become integrated within the same protocol.
Hello, my name is Mikael. I am co-founder and CTO of Gearbox protocol. And Gearbox is quite unique because we use a little bit different lending paradigm. So instead of capturing one coin as collateral, we use hooks to really keep all assets liquid on your account. Literally, you have one asset on your account, you borrow others, and they are available. Instead of locking everything, we subscribe on hook, And each time you make transaction with this account, we check that you have enough money to pay the debt back. So it works like decentralized prime brokerage and create a lot of great opportunities to farm on both assets. So nothing is locked. You can really open and do whatever you want, like with normal assets, but it's 10 times more on your account. And regarding to users, I think it's a very good question. Historically, we have a lot of degens who use Gearbox, and it was a very fun regarding to the yield question when it was a points mania. People really come from both sides, and it was a very fun game because no one could predict how much points will cost. And then it was a game where Gearbox work as a system which finds the true value because people from the LP side believe, hey, we really win the game and points will cost lower. It's much better to be on LP side. People who borrow them believe, wow, we will be multi-millionaires because, of course, it was millions after that. So it was really good times and still a lot. We have a lot of small customers. It's like a native adoption. And now we launch permissionless when curators who want to build on top of Gearbox stake could really do this in a very easier way, use a lot of stuff, but I can talk a little bit later about that.
Vic?
Hey guys, my name is Vikram. I'm one of the co-founders of Superform. We're a permissionless yield marketplace. So anybody can list their yield products on Superform and then access it from any chain. Have over 70 protocols that have done that. Some of them, actually all of them on this stage, and some ones before that, even in the food farming era. But yeah, it's been fun to see the entire progression of yield go from that era built on top of stuff like Uniswap v2 to the points farming meta, and then now you have real stable lending borrowing protocols that are generating this yield in entirely different ways. But yeah. Excited to be on this panel with
Customers. You have interesting customers.
Yes. All retail. So that's been another really fun part of it, because what retail users are looking for in yield is substantially different from what a institution might be, and points were a big part of that. So,
hey, I'm Sam. Spark. We're working on Spark, which is the largest on-chain capital allocator. Working to deploy the Sky, formerly MakerDAO, balance sheet into the best yield strategies at scale. So we deploy capital into 3.7 billion currently into a mix between DeFi, CeFi, and TradFi, always rebalancing between what the best yield sources are at the time. So yeah, I mean, who are our customers? There's two sides. There's Spark Savings, which is, even like retail can be involved in this, but we also get like treasuries. Anybody who wants to earn good at-scale yield, Spark Savings is one of the most liquid, high-yield products in the space, with about 2 billion in active liquidity for redemptions at all times, and striving to maintain at least a 25% cash reserve. And then, so on the lending side, increasingly, it was more like DeFi natives, but increasingly we see demand for institutional borrowers, especially against Bitcoin. Historically, Maker's been more like Ethereum, on-chain lending, but for many different reasons, maybe institutions don't want to wrap their Bitcoin on Ethereum. So increasingly, we've been deploying capital into products like Maple, and as well as this Coinbase Bitcoin borrow product that they've put out. So Spark is about 82% of the capital provided into that market. And then, continuing to expand on that, institutional Bitcoin borrowing is really where the growing segment is.
Thank you. So I'd actually like to start off by defining yield, because in traditional finance, this is traditionally linked to, what we consider as true economic activity, savings, loans, interest, fees, etc. But in DeFi, that can be a bit different. And so I'm wondering, actually starting with you, Mikael, I'd love to hear from you first.
Okay.
What is yield? How would you define yield, and where does the money come from?
It's a very interesting question, and for them, I believe it's a very, very complicated to say about the whole yield in our ecosystem, it grows faster than I can even read the Twitter. All projects going, but in majority cases, just a small history of the yield. Of course, people who believe that the industry will grow faster than inflation really decided to keep their crypto and borrow some stables. It's how the first lending comes to scene, and the problem was solved. I am not interested in 2020 or 2022 sell my ETH. I have a strict expectation that tomorrow it will cost much more. So I was pretty cool to borrow these stables just to cover rent payments, grocery, etc. And all time when the industry is growing, all time we can see a new shift in ideas, because only ideas and developers, in my perception, build the new future of Web3 usage, and it's create some attention from people who start using products, build things, etc. We have a kind of some expectation. Hey, tomorrow ETH will cost greater. So people go and borrow these stables, and it's create a really good yield. What happens with points, what I already mentioned? The same things. People really expect it. It's a very new and novel idea, good concept, well executed. And of course, this yield was on a high level. When there is a kind of lack of ideas in the market, we can see that the yield go into the same level like in the traditional finance, because literally we can have RVA, but there is no big difference. You put money into this RVA directly from your pocket using Web2 or using a blockchain. So it's literally the same.
So I'm curious to hear from, thank you. I'm curious to hear from others on the panel. Would you qualify points as a real yield source today? And if so, how do you think about that? I'll start with you, Sam.
I mean, yeah, definitely. This is actually what most of the yield, it's definitely temporary. I'm not saying it's a sustainable yield source unless there's like some cash flows on the other side supporting the token. But yeah, this is like primarily what a lot of the yield farming that's going on right now. But I sort of look at that as like an ephemeral yield source that's kind of sitting on top of the base sustainable yield, which the primary drivers for yield, there's really like three at-scale yield sources. There's the base yield, T-bills, which is RWAs. There is over-collateralized crypto lending. That's another big one. And these are users who are primarily paying for leverage, but they can take out loans for other reasons. And I would actually like to see more use cases where people are using loans for daily expenses, this kind of stuff. And I'm actually seeing more and more growth in that sector. But historically, yeah, it's been, and it still is today, people are using it for leverage. And then similarly, perpetual futures on centralized exchanges, the funding rate, that's the other big source of scalable yield. But again, it's all for leverage. So that can't last forever. Eventually, we need to kind of have the industry mature and get yield sources where, again, what I was saying, like people are using it for expenses or, more everyday kind of stuff. Maybe they finance a house or something like that. These are kind of more long-term sustainable yield sources. So we're still at the very early stages, and yield is primarily driven by speculative demand on Bitcoin and ETH and other crypto assets.
What do you think, Mikael?
Well, yeah, you could go quite deep on this question, I think. I mean, fundamentally, like the easy answer is where does yield come from? It comes from borrowers. That's the straight up answer. But like, why do people borrow? Well, I agree with Mikael. They're usually borrowing because they're taking a bet on the future. And that can be any kind of bet. It can be a bet on the future price of ETH, or it can be a future bet on the growth of a company, or it can be a bet on the future growth of a whole economy and country, right? So that's fundamentally where yield comes from, is people paying a fee so that they can access more capital up front now so that they can grow. And so, yeah, in terms of points, I think they're a bit silly and I don't really like them, but they are real yield because they're effectively projects issuing a kind of like really messy type of debt, I think, that they're sort of putting out in order to help drive growth. And yeah, it's a crypto native version of borrowing, I suppose, but it's kind of messy, but it's certainly real in some sense. It's just very hard with points and some sources of yield in DeFi, I think, to actually value these things. When a company issues debt or a government issues debt, you can pretty easily sort of value it. Or there's lots of people out there able to look at do analysis and try to come up with some kind of cost. And I think that's very hard to do with points. So it becomes way more of like a farming game than anything else.
Vic, I'm curious to hear your thoughts on this question, and specifically if in your experience, like users have any distinguishing between what might be one of the more real yield sources versus some of these more illusory sources?
The retail behavior, consumer, and DeFi is quite hard to pin down. We actually found, if anything, that protocols that offer points are more likely to get outsized amounts of TVL because people are speculating on something that doesn't exist yet. So it's just part of the whole, mentality of. And Athena kind of started this right through their season 1, and that was a huge moment for a lot of people that were just farming points. Is that they actually ended up getting 150% APY on something, but if they had published that number, then it would have been a lot harder for them to have like a lower amount of TVL in that. I think points are, in a way, just a way for users to kind of benefit in some pre-seed funding almost for a protocol versus when you have a token, like you're already kind of Series A. And it's just kind of moving up the risk curve for a lot of these people that are already providing capital on chain. But yeah, exactly what Sam said. I mean, right now, it's so far all this demand has been for the rates are dependent on demand for crypto assets. And I think we're going to have more and more of these rewards that are given out for participating in DeFi move from points to real yield as we get more real stuff that we can actually give out to people.
Great, thank you. Curious to hear your thoughts around like the different risks, right? So how you're thinking about, and Sam, I'm actually curious to start with you here. How are you thinking about distinguishing like the risks between some of those more base layer yield rates versus like the more speculative bets on the future, such as points programs? And are there any warning signs, between the two? Or is there anything you're monitoring for in terms of understanding those risks?
Yeah, I mean, as like speaking from the lending side, like we're not taking any bets on anything really. Like we're just supplying capital so that people can leverage their interests in taking directional bets on the, any particular points program or even just crypto itself. So the way I view, and I'll go over like the 3 categories that I mentioned. So T-bills is the risk-free rate. There's some nuance in that the RWAs have like custodians and stuff like that, but more or less you consider like that to be like essentially risk-free, with some nuance there. What I would also consider like extremely low risk is on-chain over-collateralized crypto lending, and this is what Maker's been doing from the beginning. There's actually been like no defaults with the highly liquid ones like Bitcoin and ETH and LSTs and stuff like this. Like it's just like proven to be a super robust and still accesses most of the yield that comes in bull markets. So actually I think this product is one of the most compelling things that we can export into TradFi. People who want, they're on fixed income, pension funds, this kind of stuff, who want access to this like they want good returns on their capital, and TradFi is pretty much exhausted with that stuff. So crypto is a very new and shiny thing that can still give you like these, even double-digit yields sometimes in bull market conditions, while remaining with, in particular, the over-collateralized crypto lending can still remain. I think it's still a relatively safe thing to do. And so that's most of the balance sheet of Sky right now. And then the last thing is the perpetual future funding rate on centralized exchanges. This is definitely higher risk. Exchanges have hacks and stuff like that sometime. But I think there's been big improvements in how this is managed. I think the most infamous case, the recent Bybit hack, that affected like Athena, but because of their segregated custody, they were actually only marginally affected. There's definitely, it's not no risk, but it's like far, far better custodying the collateral off the exchange with a qualified custodian. And so these types of improvements drastically lower the risk with these types of things. But as with all lending, it's about, the structure of the loans. So we have more advanced types of structures, in particular with Spark, we aim for more senior positions a lot of the time. So spinning up like a morpho market, for example, or, can do this on Euler or whatever. It doesn't really matter. But you can have these isolated markets where you have junior equity tranche sitting in front of you. These are loop leveragers, and so you get sort of the nice. You capture most of the yield as the lender, but you still get this like nice buffer protection for events where there's like a shortfall of maybe 10-20% in the actual end asset. So these types of structures, and it's really cool. I mean, this is why I love DeFi. You can plug all this together on chain, and it's all very transparent. And I just am still always think that's the coolest thing ever. But yeah, I mean, risk is just such a complex thing, even in TradFi. So with everything that we're investing into it, there's always a very rigorous analysis on many different fronts for risk.
So I actually want to, you bring up data and the fact that it's all on chain. And I actually want to throw that into the mix here is how are you guys thinking about using on-chain data to really make transparent those different risk levels across the different yield categories as Sam put them, and how that's factoring into your strategy? Go for it.
Well,
again, the question's how do you identify a potential big risk or a big Ponzi-like risk, right? How can we use different on-chain data analytics to really understand the different types of risk and take it from there?
Well, I would say collateral risk is the main thing, and it's quite subtle because it can hide. There's a history in finance where you have something that's volatile and people speculate on that, and then people want to essentially get the returns, but without the volatility and the risk that comes with that. So then you compress the volatility into a kind of lower yielding, lower volatile product. And then people build back more risk again where they start then leveraging that and start going, leverage looping on those. That's kind of what you're seeing with Athena today. And the tricky thing there is that I think it's quite hard sometimes to see the underlying risks and actually work out how robust the entire system is. If something goes wrong, one area, it can actually have dramatic effects on a completely seemingly different pool of capital. So it is really tricky, but as Sam said, what's very nice about DeFi is that it's all transparent and it's on chain. So it's hard to do the modeling, but it's more possible than it ever was in TradFi. When we saw the collapse of the banks in 2008, piecing back together what went wrong was a real mess. It took years. I don't think it's even really been done today. Whereas people can kind of do this in real time in DeFi, and we see people now, bringing credit scores and other scoring metrics, risk metrics onto the market, like Credora, other people like that, trying to assess risk. One of the nice things about, one of the, I'd say, complex things about financial markets is people always, there's this life always finds a way, and I think it's in financial markets, it's that people always find a way to sort of collateralize something and take more risk. So whenever you just get this sort of massive expansion of collateral on collateral on collateral, and leverage builds into the system. What Euler does is enable anything to be used as collateral, but it then allows it to plug into a kind of well-defined network so that you can actually trace the collateral relationships among assets. So hopefully that should make it easier for risk analysts to assess the risk, but it's not something that we personally do. Most of the people who build markets on Euler are other risk curators and capital allocators. I don't know
what's happening. Hello? Okay. Thank you. Vic, I want you to take it.
Yeah, if there's something I feel like crypto's done really well over the last few years, it's standardization. And I think everyone on this panel is built on a standard called ERC 4626, which is for tokenized vaults. Yeah. And if you were to look at how people would have done all this risk analysis 3 years ago, you would have had to create adapters for every individual protocol, be tracking separate events, individual like state variables in contracts. You might still have to do that actually, but the fact is that now you can actually get all this stuff, APY, TVL, basic metrics directly on chain and indexed through subgraphs very efficiently. So at a large scale, it's easier than ever to actually do this kind of transparency analysis on chain. But yeah, there's this whole another level to it, which is the actual logic within these contracts and how is that risk compounding. But I think at this point that has to be done by individual curators or risk people that are just specializing in that. It's going to be a whole new industry that evolves.
Sam?
Oh, sorry, what's the question?
No, so you actually already answered it. We start with you, Mikael.
So I believe we are in a pretty interesting place. So literally before, I think a lot of us read tweets from Vitalik and other crypto founders, do not trust crypto, put as much money as you are ready to lose. It was a stage of the market when people do not trust the crypto by like existing system. It was a very innovative, very high risky, and it's why we have so high yield. And now I believe we are in the era when we have a great foundation currently. We have proven models, we have protocols like in Gearbox, which works for years with zero security incidents, etc., etc. And people start to trust them. And now I predict it will be distinguished between people who are really interested, like a safe part for their money. It's a strong demand, especially from a big capital, who are not interested to play the casino, who want to expectable returns. And in this case, this analysis from on-chain data, combining with some attention data from the social networks, news, etc., could be very, very beneficial. But still, the high yields would try to figure out the most risky place and build new products. We also were witnesses of this meme coin mania. It's really, no one can predict why this meme coin could be better than other. Yeah, we have still no mass equations to evaluate these meme coins, but all this high-risk activity try to figure out new form. And I believe new innovations will be totally different. Now we have a foundational model, especially on Ethereum, very good, innovative DeFi infrastructure. And now it's become more and more stuff. I really appreciate Superform with launching this stuff, who put money across different pools, because we have a monitoring system and all time when we see someone put money, take money after a few minutes, put money, take money. We said, what's going on? Why someone deposit and take like a 5 million, like in a few minutes? Maybe it's a hack, maybe it's something, because we immediately detect this anomaly. And why? Because it's one small change in interest rate ask bot, because now gas is not so costly to move funds. And I believe for such kind of product who really have a foundational stuff which is more predictable, this new innovative tokens, it will be more and more automated, like a Superforms. We as a lending will create a different way to build collaterals and do this, and people will be less involved. But for higher yields, you should go to some very innovative place, and I can't predict what it would be, the next generation of crypto projects, when it would be still unexpected and very high and lucrative in terms of yields.
So let's actually talk about the future yield users to come, if you will. So when you guys are looking forward at both institutions and different retail players, how are you thinking about I guess, a maturing yield industry and what that means for the different types of players? I think this also, in your case, includes developers, right? So which is like a new type of customer for yield products. And so interested to hear from each one of you. We'll just go down the chain about the future customers of yield as it relates to your specific context.
Is this working? Yeah, this seems to be working now. Yeah, so on Euler, I think we have a unique system which allows people to build all sorts of different types of credit markets. And so in some ways, Euler's not really a product for end users, it's more a product for builders, so that they can build yield products, I guess, in their own image for different classes of users. Some people want high risk and high reward, and other people want to take more of a more low risk senior position. Fortunately for us, a lot of the time we don't, as the developers of Euler, we don't have to have a strong opinion on where these things are going to come from. We've been amazed at times to see the kind of things that people build on Euler. They're not things that we would have designed. They're not. We haven't. We don't know where the lenders and borrowers are coming from necessarily.
Do you feel like the builders are asking for different features now?
Yes, 100%. I think there's a swift change towards looking for features that provide more consumer protection, so better security features, I think, even when they come at the expense of the level of access that you could typically expect to get in DeFi, which is normally just full permissionless. But I think there's a move to from some builders and other institutions, I think, that want to now come into DeFi, but bring on board some of the consumer protections and maybe compliance and risk checks that you would expect to see from an institutional grade product in TradFi. So yeah, that's certainly been quite a big shift. Fortunately, Euler's set up for that, so we're doing quite well on that front at the moment.
Awesome. Thank you. Go ahead.
Can I answer to your last question about innovations? I believe currently the stack is pretty mature, but the new yield products are really diverse. For example, now there is a very common practice to implement these delayed withdrawals, which exist on RTs, which also connected to depositing money to Beacon chain, etc. And for example, in Gearbox, we have a quite unique feature comparing on all other lending markets, because we do not really take as collateral these assets. It is still liquid. You can really keep it on your account and start withdrawal from original protocol and do not pay the slippage. So literally, if you have an LRC and you get 3% APY and you have a slippage of 0.5%, it looks like you pay 2 months of farming for someone who give you faster. And it shouldn't be done with looping, because if you loop like 7 times and the time is a week, you should wait 7 weeks, which is also not an option for you. In Gearbox, it's much faster, and it's like the last feature we implemented, because the market is changing. It's never stops. Luckily in crypto, we can find new and new things in different token implementation and yield generation, which requires a little bit different approaches to keep them on the stage. But before taking, I believe Superform also did a great job to make another layer. So some innovations will also be in automated management of the risks of yield, of borrowing strategies. But I think you are a better person to tell about that.
Yeah, Vic, I'm curious really to hear about your customers and who you see as the future customers of Superform, the future retail DeFi users, and also, whatever specifics you can share about where they fall on the yield curve, if you will, in the different customer segments as you see it.
I think the end consumer that's looking for yield, we've just scratched the surface of it, really. And I think the cost of capital for crypto users right now on chain is actually quite high, which is why you have all these, more elaborate programs to try and get TVL. A lot of people in the fintech world are stuck on apps like SoFi and Wealthfront and even Robinhood, where they're getting 4 or 5% APY. And the barrier for them so far has just been because they don't really understand what's going on chain, and no one's really created a nice onboarding experience for them to just go from bank account, from card, whatever. So the next version of Superform we'll be launching shortly is we'll have a mobile app onboarding through email, passkey. It'll really feel like you're using a Web2 app to get into crypto. I think the customer segment that I think has the most space to grow is this near term, is what we've termed like a Web 2.5 user, which is currently like somewhere in between Coinbase and some earn platform on off-chain, like Binance or OKX. And they are okay with the centralization right now, but they're not able to really like participate in the true, just degeneracy of DeFi on chain. And then those people are eventually going to come and use DeFi protocols directly. But yeah, the actual retail consumer base, I think.
What do you think is the target rate or the range, I guess, for those Web 2.5 users? What are they seeking?
It's actually, our product research on this has been really funny, because you'd think that it'd be something like, oh, they want 20% or something. But actually, they want something that's only a couple percentage points above what they're getting right now. And they just want to know it's safe. Yeah. So if there's like mechanisms to create an insurance on chain or some downside protection, I think that would be, that's a much better product than just trying to maximize APY, for sure.
So that leads us to a point in the industry where it seems like the customer base is willing to accept a slightly lower yield base, but is actually seeking more sustainable, reliable sources, right?
Yeah, and it's kind of just distilling our own heuristics at this point, right? Like, I think if any of us saw 50% APY pool, I would stay away from it, even though maybe 3 years ago that would have been the first thing I went to go deposit to. So yeah, industry growing up a bit, I guess.
Sam, I actually want to ask you a slightly different question, which is that I know you just went through your TGE with Spark. Congratulations. And I'm curious, in terms of generating a sustainable strategy, you could talk a little bit about how you thought about that in terms of your TGE as a yield play and rewarding some of your early users, and how you approached it.
This is working. Yeah, like so. I think it's important to build like a community around the project. People are very interested in what you're building, and sort of just have. I mean, this is kind of what DeFi is all about. Like having people have ownership in projects that they're interested in. So yeah, I mean, the TGE was pretty great. We're glad it's done, and now we're moving on back to products. But I think I actually want to address more the earlier question with the future of yield. So actually, the way I view it, I think actually we've reached the peak of a pooled lending model right now, and I think it's a relic of the fact that there just wasn't that much diversity in credit on chain. So us as a capital allocator, we're not actually building lending infrastructure ourselves. We use other protocols such as Euler, Morpho, Aave. And so we also have an internal lending market, Sparkland. But our bet is more that the future is going to look a lot more like lending's done in traditional finance. Traditional finance does not have one giant pool where everything is rated the same risk, and there's a giant pool of lenders that just like lend in one giant bank, basically. That's not how it works. And I think we're reaching the peak right now precisely with the introduction of private credit. So you see new options becoming available in RWAs. This sort of diversity is only going to accelerate. And so, yeah, we're really taking a bet on this more nuanced, more institutional style of loans. We talked to lots of institutions, and so, yeah, again, they're not going to be borrowing from these giant pools. They're going to be more looking, it's going to be very, very specific needs. And so I think projects like Euler and Morpho are taking the correct bet, and the future is going to look more like isolated markets, just more and more diversity of like options available for the lender, the borrower. Yeah, that's how I view it.
Thank you. We've got 3 minutes left, and so let's have a little fun. It seems like there's pretty wide consensus here that the industry is indeed maturing, that there are more real yield sources, that there's a greater connection. In many ways, it refers to like a convergence between DeFi yield products and TradFi products. It's a theme that's emerged here. But I'd like to throw back to the type of stuff that only crypto can do. So I'd love to hear from each one of you. What was your favorite, most degenerate yield model that you came across, and how can that provide sort of a cautionary tale to users that are entering DeFi today?
I mean, there's been loads over time. I've not been a massive player in this, to be honest. I just don't have too much time to just sit. I'm by nature, I think, quite risk averse. So as soon as I see yields getting too high, I sort of get scared. So but in the early days, there was the yam farming and the.
But from a model perspective, what's one of the more ridiculous things you've seen?
Just from a pure like mechanistic thing. I mean,
let's say if the theme of the panel is DeFi yield real, the most unreal.
Oof. I mean, we've done some fun experiments ourselves in our time. Yeah, I mean, we realized that people were at one point just farming Euler tokens aggressively, but they sort of couldn't farm hard enough because of the constraints on the LTVs. So at one point we said, well, why don't we let people self-collateralize their USDC so that they can farm Euler tokens? And it sounds kind of stupid because you're just lending and borrowing the same asset, but actually what you're kind of doing is then exchanging USDC interest. You're paying the spread to then basically farm the Euler tokens, and so that was one of the silliest things we've done, I think. But it worked quite well actually, and it made the market more efficient for farming.
Would you do that today?
No.
Go ahead, Mikael.
I really like, in terms of yield generation, the projects which have some foundational stuff. In crypto, the most great source of yield, of course, is risk-taking, because the money comes of real Ethereum usage. And of course, each integration with this yield source it's not a speculative, it's how the lending markets grows together with the whole infrastructure.
Yeah, but that's a different question. We're talking about the most ridiculous.
It's not ridiculous. At my point, it's like the way how real blockchain usage generate money and they could be yield. And in terms of lending, it's more related about your agreement and expectation about the future. So it's like a mortgage. If you believe that the price of your flat will be much lower in 10 years, you should not really take a mortgage. It's much better to rent. But if you believe that market will goes up, it's totally fine. And it's why I believe the projects which still create a good flow of money into the industry development, not just to move crypto funds into TradeFi, etc. We still build Web3 as a unique phenomena which makes and have a different values than traditional finance. And I hope it will be still in our hearts. We will still focus more on decentralization, etc. And I am very happy when we support like money who goes to grow Ethereum ecosystem itself for V model, which is a very innovative part of Curve, which is also nice because you have some time horizons, and in blockchain you have only energy in Bitcoin and time because you can really make a lock and no other real resources.
Those all sound like real resources to me. I'm going. We have no time left, but skipping through most ridiculous stuff.
I think the craziest thing I've seen is like the whole tap to earn thing, right? It's like, I mean, people like there's hamster wheels and people are
smoke to earn, vape to earn.
Have you played?
I have downloaded it.
Okay.
But yeah, I guess yield isn't necessarily even something you have to earn on money, right? It's like you're just investing time into this thing, and the fact that you can actually like play to earn and make money is also something that I think is pretty cool and unexplored.
Go for it.
Yeah, I mean, in this space, there's always like funny stuff that pops up every now and then. I think there was the recent one. What was that stablecoin that was pricing for your bonds at like $1 or something, and then inevitably it just priced to the actual price, right? So yeah, that was kind of amusing.
Funny. All right, we're out of time, but thank you all so much. Seems like DeFi yield is real and getting realer. Thank you all very, very much. Thank you, Stable Summit.
Thank you.
Thanks.